Okay, good afternoon, everyone. Welcome to this Aptitude Software and the CFO webinar, Navigating the Impact of ESG Regulations in Your Finance Teams. My name is Krzysztof Kozłowski. I'm the Chief Product Officer here at Aptitude Software, and I will be your moderator today. Before I introduce the panel, I just wanted to go over some housekeeping items. First, please feel free to submit questions at any time throughout this webinar. But please note, we'll only be answering these questions at the end of the webinar. You can submit your questions using the question tab at the bottom right side of the screen. And if you have any technical issues, please submit your queries using the same question tab, and one of the CFO staff members will assist you. If you're looking for additional resources, these can be found in the handout tab, which is accessed by selecting the three dots at the bottom right hand of your screen. I also wanted to highlight that we will be asking you to complete some polls during the webinar. They will pop up on your screen. Please complete and submit your answers. Lastly, this webinar will be available on demand after the webinar, and you will receive an email with the information in the coming days. So with that in mind, let's just open a first poll. We'd like to know how well progressed your company is in terms of the implementation of ESG reporting and disclosure requirements. Please complete that poll, and we will take a look at that and the results in just a few minutes or so. With that out of the way, let's do some more introductions, and I'd just like to introduce your panel to you. So if we just start with perhaps Mark.
Hi, good morning, everybody. My name is Mark Lumsden-Taylor. I am a partner at MHA McIntyre Hudson Baker Tilly International and the head of sustainability for the UK.
Nick Stewart.
Hi, good morning, everyone. My name is Nick Stewart. I'm a partner at Baringa. We're a management consulting firm, and at Baringa, I lead our climate change and CFO business.
And finally, Nick Shah.
Hi everyone, I'm Nick Shaw. I work for Aptitude Software, where I lead the product strategy for finance digitalization products.
Thank you very much. So if we just go full screen, I think just for the colleagues, thank you very much. So let's start with a first question. We'll come back to the poll results a little bit later. So maybe just to frame the conversation in the first instance, Mark, it'd be interesting just to hear from you and get an overview of what you believe the ESG impact is on the finance function, in particular, reporting, risk, but also the role of finance.
Yeah, thank you. I think it's a pivotal question. So I think environmental social governance, just to make sure that everyone understands what ESG actually means different things to different businesses. And whichever way you cut the current situation, the ESG agenda will affect a business in some way, whether it's material or immaterial, it will affect it. So I break this down into four elements, if you like. Finance, by its very nature, is the custodian of data. It is the reporting gatekeeper. Without finance owning any form of reporting, it's not going to go particularly well. So first and foremost, finance owns the data. So as a result, environmental social governance work will have an impact upon finance. The second thing is regulatory reporting and associated requirements. The UK is far ahead than most countries. Europe is obviously going through an alignment piece. For those of you that may have got Europeans on the call today, taxonomy and CSRD is a major agenda for reporting for Europe. In the UK, it became mandatory 1st of April 2022 that if you have got 500 staff and are a £500 million company, you are mandated to implement what is known as Task Force climate-related disclosures. We'll go into that, no doubt, a little bit later. That is a really big piece for those companies, mainly around listed entities or entities of special interest, or PIEs as they are also known. Now, underneath that, so you think that doesn't necessarily affect me, underneath that, of course, is the other regulatory disclosures, which are around your emissions and how much energy you use. They are called Streamlined Energy Carbon Reporting, SECR for short. And energy savings opportunity schemes, ESOS for short. We won't go into all the detail of where they're applicable. It's mainly mid-sized companies. So those companies, you get caught out by these as well. So finance needs to control and regulate that data. It's about your emissions, and it is about how much energy you're using, keeping the absolute basics. Third thing is audit. So most companies that fall into audit regime, so I put my auditor's hat on today as well, we're duty bound now to evaluate climate risk and what impact that has on the financial statements. Under FRS 102, we are required to evaluate those impacts and decide whether or not it will affect your going concern. As a finance function, you need to be aware of all of that when the auditors come in and pay you a visit. So how are you prepping for that? And that's often the thing that people don't necessarily realize. Audit's changing big time. And I think the fourth thing, which is probably the most important actually, when you deal with all your regulatory and statutory perspectives, is finance is the engine to impact the way in which you impact the world on your environmental social governance frameworks. ESG is a framework for business. That is why it was created. And let's not forget that. It's about how can you do well and do good at the same time, not just do well and then do good down the road. So ESG foundations sit within finance. And if it all tracks back to that, in terms of your data, your information, finance can be the powerhouse for change. And your CFO should be the custodian of ESG. So that's it in a nutshell.
Thanks, Mark. That's really helpful. And maybe if I just sort of go and dig a little bit deeper and maybe ask a question that many are thinking. And Nick Stewart, you know, when we used to work together and we served some of the large banks in the UK, and they were going through the Basel Capital Court implementations, IFRS 9, stress testing, and so on. It wasn't quite clear at the outset whether it was all going to be the CFO and whether the CRO also had a significant role in that. And in the end, there was a bit of a balance that was struck where it wasn't all the CFO, it was the CRO, and then there were some top line reconciliations potentially. Do you foresee both in the financial service industry, but maybe beyond as well, that, you know, we know that your CFO is going to be the custodian of the data, but are there going to be other functions in the C-suite that is going to have equal accountability here?
Yeah, Chris, I think it's a great question. And if you look at financial services first, then talk about corporate markets, we've seen in financial services the CRO has often led on climate and sustainability. That's partly because Mark Carney in the Bank of England, as Mark mentioned, TCFD and climate stress testing has been a kind of risk-led exercise. That said, as we all know, and I can see a lot of the participants on this call are from financial services, we all know, and I'm an ex-auditor and finance person in a bank, so I can say this, finance are often too late to the party. And I think we saw that with IFRS 9, we see that with other changes, and I'm excited about climate sustainability. As Mark said, you've got things like TCFD, you've got the ISSB, you've got lots of four-letter acronyms, which basically means we're going to have a huge wave of financial reporting requirements, whether you're UK, European, Asian, American. And as Mark said, again, using his mentioned, the engine often of an organization, whether it's the internal financial reporting, the MI, the business partnering comes from finance. As we said, they own the data. And also that external voice to the market is incredibly important, whether it's investor relations, how you're communicating with shareholders, investors as well. It's going to impact capital. It's going to impact the price of you being able to raise funding, share price. So it's a really exciting time, I think, for the CFOs to get involved. When you look at non-financial services, I speak to a lot of clients in our corporate sectors. They don't have the same risk framework that regulated firms have. So often we find the CFO or the finance function is the first port of call. You know, the TCFD requirement is landing in the CFO function, think about how it impacts the organization. And so, again, I think it's a tremendous opportunity to look at the end-to-end, how you do business, how you engage your customers, how you even engage your employees. And I think the finance function and C-suite, along with other execs, has a key role to play there.
Great, Nick. That's great. And I'll come back a little bit to the engine point in a moment. But maybe Nick Shah, From your experience of having delivered very large finance transformations, bringing together the full operating model, technology, data, and I know we'll probably go down in the data piece a little bit further down the line too, but just in the context of, shaping up how an organization embraces ESG, and actually also with a mind to the execution piece, and not just, the compliance piece and understanding the regulation, but how do you get it done? What's your sort of perspective around, reflecting on your experiences around how to best shape that execution journey early?
Yeah, absolutely. Following on from what Mark and Nick have articulated around why finance will be the custodian of ESG reporting, it's really important to look at the full impacts across the entire finance architecture, because it's not just in one particular area. It will be quite pervasive in terms of the impacts of ESG reporting across the finance architecture. We do have a slide prepared that could be useful to help with that conversation. If we can just bring that up, please. This is really just there to give a generic overview of the finance architecture of a generic organization. I will talk through some of the points on here just to call out where we see some of the impacts. But I think the first and probably the most important observation to make here is, we've not shown a separate ESG architecture. We've not shown it as something that's separate to the finance architecture. And that's absolutely key. It's really around how do we really integrate ESG reporting requirements within our existing finance capabilities. And that's key from an implementation perspective, is not to look at ESG as something that you can just bolt on into a finance architecture. It's got to be fully integrated with your existing finance processes and data flows and applications. In terms of some of the specific areas, where we're seeing the impacts, firstly around accounting rules, we obviously expect there to be impacts around how we account. And obviously that this is an area, and it'll be good to get Mark and Nick's input on this as well, where I think the regulation is a little bit further behind than what we've seen in the reporting and disclosure space. So we have heard more around what's going to be happening around carbon emissions accounting, biodiversity accounting, but there's not yet any confirmed rules or regulations in terms of how that's going to be implemented. So that will definitely drive an impact in the accounting rules space. The second area we're looking at was obviously around additional data. So we will have additional data sets that need to be integrated into a broader finance data architecture. That could be external data sources, further internal data sources. I know we have a number of financial services representatives on the call. A lot of that will be around how you capture data from some of your clients and further information around where loans and insurance deals are being booked to, that will need to be fed into the reporting and disclosure processes.
Great, thanks, Nick. And I think we'll come back a little bit to that picture a little bit later when we're starting to talk about data sets and so on. Our poll has come in, and what's very, very interesting, maybe just before I kind of go to the next sort of theme around our questions to our panel, nearly half of you, so 46% of you, are in the assessment stage. A quarter of you have not yet started. Interestingly, just above, so 14% have implemented an interim solution, and 14% have implemented a strategic solution. So, that's a little bit what I've been seeing as well, that the majority are assessing and understanding what this really means. If we just go back full screen, please, for the next question. So we talked about the engine, and we've all said it in terms of how finance is going to sit across all of that. It'd be good maybe Nick Stewart in the first instance, also maybe with your ex-auditor hat on, what are the kind of, accounting rules, what are the calculations, but what are also the disclosures that are beginning to start becoming clearer or indeed confirmed in terms of what finance functions are going to have to start to think through?
Yeah, it's a great question, Christoph. Mark mentioned there's so many four-letter acronyms, but one of the key ones on TCFD, which is the Task Force for Climate Financial Disclosures. If you look at that, you have to talk about strategy, governance, risk management, and also metrics and targets. And if we double click on metrics and targets, this is where it's really tricky. Companies, and again, Mark mentioned, companies have to start capturing their scope 1, scope 2, and scope 3 emissions. They have to think about the end-to-end what they do, whether they're a bank lending money, an insurer investing in assets to provide offsets for policies, or a corporate making cars like VW or Tesla. So again, the finance functions role is going to be really key in this, because we're starting to see it already, but there is going to be a real need to have new data sets that previously haven't been collated or identified. Things like if you're a bank that lends money to customers as mortgages, you've never needed to know the full postcode of where I live, and where I live near my neighbour, because I may live up a hill and my neighbour may live down the hill nearer to the river, and therefore the house is more subject to flooding and has more climate risk associated. So that's just one example of it. So I think there's a huge wave of reporting requirements that are going to need to be met. And again, I think finance's role, both as business partner to give the business the data they need to run the business, but also in terms of that external lens, in terms of the reporting requirements that need to be audited and what investors are asking for, is going to be really key. And one point before I often get the challenge from clients saying, oh, well, our big investors don't care about this yet. That's completely false. I was just on a call with one of the biggest banks in the world last week, where the largest equity investors in the world, we're talking about the Qatari, the sovereign wealth funds, all of the questions at many AGMs are coming around ESG, climate and sustainability. What are you doing about it? So people often say, well, this is another regulation and I've got lots already to do, especially busy finance functions. And yes, it is, but it's also an opportunity to make money and manage risk if you do it well. So I think that's the incentive to get it right.
And I think that's probably a good follow-on, Mark, because the sort of question I had around just the investors and so on is actually, and you know, shows my age a little bit. I kind of think around 2003-4, when the Basel Capital Accords came out and IFRS came out, there was a lot of kind of reaction, which is these are all just accounting standards, and you know, should we really be doing them and so on. Then organizations realized that investors are very, very interested in organizations actually doing it. And
Absolutely.
Then it became a story of how do we actually start working with the regulators to lobby, influence, et cetera, which then resulted in things like the IAS 39 carve-out and so on. How should organizations think about participating in this debate as opposed to just being recipients?
I'll add a couple of points there, actually. So the first thing to say is that with the debate, businesses can only influence the debate by being involved in the debate. So there are a number of steering groups at the ICAW. My colleague, technical director of ESG for MHA, sits on that group. I sit on the CBI National Advisory Group on TCFD and alignment with EU regulations. There is also the Accounting for Sustainability Network. I also sit on that, but there are also a steering group in there as well. And all those three primary groups lobby into government to talk about what is the next steps for the cascading of mandatory reporting on TCFD. So those large-scale entities, most of them should be members of the CBI. If they're not, then you need to consider that, should think about joining or at least being part of those network groups, because you will find out where the direction of travel is going. Nick is absolutely right. There is literally hundreds of acronyms out there. And if you, and I caution people on this talk to not do this, do not put a search in saying regulatory reporting ESG, because you'll frighten the life out of yourself and you'll go, oh my God. And one of the dangers is, yes, there are reporting requirements. Yes, they are for listed entities in the main. Obviously against those, the criteria are outlined earlier under the 4 categories. But within that reporting criteria, what is really important is the granularity of the metrics. When I've evaluated and reviewed numerous TCFD reports over the last, 3 years or so, the greenwashing and green nonsense, if you like, or green wishing in those reports will get called out by investors. And you only need to look at what happened when I think Deliveroo listed. They didn't get an ESG framework in place, and I think their share price dropped 25% on day one. So the importance of the not only the framework for ESG, but not over-promising and not greenwashing your data and information. Be honest about your data and then map out your pathway under TCFD regulations, because that is also what the auditors are going to review as well. So, and there's a technical term that you will hear that people will hear all the time. It's called intensity ratios and material intensity ratios in terms of the actual quantification of what you think the potential impact of climate risk will be on your organization, whether that's transitional risk or physical risk. That is very much a key pillar of your TCFD reporting. So stick to the basics. And judging by that poll, a lot of people are on that very, very, very basic journey at the moment. So start with those basic principles. And whether you like it or not, TCFD reporting is coming down the track. And if you imagine we're 2023 now, and they're talking about implementation to all companies 2025, 26, you're going to be looking at your 24, 25 comparatives now, which means your 23, 24 information is you're going to need to start implementing those procedures now to make sure that it's right for 24, 25 as your comparative for 25, 26. So it's sooner than you think. When people go, it's years away, it isn't. And that's what we are also advising our clients to say, you need to start, not frightening them, but you need to start thinking about it now. In terms of what you were saying, in terms of the data, you mentioned the data into the accounting department.
Yep.
So in terms of the data coming into the accounting department, finance relies on other stakeholders in the business. So I've been CFO for a number of years, and in both heavy agricultural industry and in financial services, etc. I made a lot of mistakes, but the thing that I got right was I brought the stakeholders together on a regular basis, and that was obviously estates, that was basically sales and business top line, HR from the S in the social aspect of this, and I also had effectively what I would call the 11th man or 11th woman, who was basically the challenger. So somebody who wasn't necessarily related to ESG, but just came into the business. So I used so when I was in education, I used a senior lecturer who knew about it, but didn't really understand why we were doing what we were doing, to challenge, because they were my marker about, did the rest of the business really understand what we're on about, or is it complete nonsense? Because there is that barrier that people will find. So that was my working group. And out of that, we had our data flows coming in to me as CFO and the finance department financial controller, and we mapped that. That was mapped separately to the finance function. Sorry, Nick Sharp, but it was because our finance function wasn't set up to deal with this stuff. And then it was subsequently integrated once the finance functions caught up with ESG reporting. So we did that at granular level and mapped out under E, under S, and under G what we wanted. That also linked into what the overarching strategy was for our organization. So collection of data at the bottom, overarching strategy at the top. And then obviously that was aligned to, we were only in line for SECR and ESOS reporting. So we weren't required to do TCFD, but most of our large entity clients do TCFD.
And I think, thanks, Mark, because I think what's quite important there is, that top of the house bringing together the stakeholders, because the data sources are now across a multitude of areas in the organization. I wonder, Nick Shah, you've been through this probably quite significantly over the last 10 or 15 years in your experience in terms of having to really start bringing together data from really very disparate parts of an organization to still be able to go and deliver, an accounting data flow that is controlled, and that ultimately also the CFO can sign on the dotted line and say, this is correct. Just explain a little bit more how to go about that again from an execution perspective. How do you bring that together? How do you make sure that you can ultimately deliver that out of the finance architecture? And I guess equally importantly, how does technology these days, because there has been such a revolution in technology over the last 5 years or so, how does technology become a game changer in that? And you may want to pull up your architecture one more time and kind of bring that to life a little bit.
Yeah, absolutely. I mean, the first observation for me, and again, looking back at some of the past regulatory implementations we've had in finance teams, it's often been a case of the requirements have been well understood or known. There's been a lot more consultation, and therefore, when you've come to implementing technology solutions, your things like your data requirements have been clearer. They've possibly not been fully defined, but you've got a good understanding of the data that you need to capture. I think with ESG, we're seeing a lot more evolution in requirements, and obviously, there's each country is at a different level of maturity at the moment in terms of its regulation. And that's causing issues, I guess, in terms of clearly identifying what you need to capture. Ideally, when you're looking at opening up data sourcing, data feeds, you do it once. You go and grab the data that you need, and therefore you don't need to revisit existing pipes now. And that's why I think new technology is absolutely key here, because we are going to have to be incredibly agile over the next 2 to 3 years in terms of how we source the required data. Some of that will come from external sources. Some of it will be improving the data capture when we onboard new clients. I think Nick had a great example earlier of the mortgage example where, again, that's something that needs to be captured almost at the point of sale, almost as part of your KYC processes, and then fed through the architecture. Now, what I think that agility is absolutely key in terms of how your front office or your capture systems feed into the finance architecture, and therefore having a very clear connector strategy is going to be key in terms of how finance brings that data in. I think the second thing to focus on is the controls around that data. Now, I think we've all worked in finance functions for many years, and a familiar problem for us all is data quality and what that then means in terms of downstream finance processes and where you end up with manual effort or manual adjustments needing to be applied. So being really clear around what does good look like when we're capturing this data. So whether that's accuracy of the data, completeness of the data, the timeliness of the data, and making sure that this is where we really need to leverage the existing finance controls and data frameworks that are in place to make sure that data, when it is sourced, we try and get it right first time. Now, obviously, there's going to be considerable challenges, and again, evolving validation requirements, evolving completeness and accuracy requirements that will continue to evolve. But again, having that agility within the finance applications to be able to rapidly change your data controls, understanding your data flows, your lineage, your transparency. A lot of what's been done, obviously, in the finance space, and some of this was driven by the BCBS requirements around data lineage. But taking those control frameworks and expanding that into ensuring that all of your ESG reporting requirements immediately fit into the broader finance control requirements. And then when we start to look at calculations, again, agility is going to be absolutely key here, because we've started to see some calculation requirements that some of our clients have been talking to us about. Mark referred earlier to the EU taxonomy and the green asset ratio calculations that we're starting to see come through. Again, that's going to need a rapid capability to implement new calculations. These aren't calculations like we've referred a couple of times to the Basel calculations. They're not going to be big calculations in the sense of an IFRS 9 calculation or a risk-weighted assets calculation. However, there's going to be multiple calculation requirements, and how we evolve and implement them is going to be key in the technology architecture. And again, having a technology platform that allows you to integrate your data seamlessly, and then second, perform bespoke calculations on that data set through a controlled finance data flow is going to be key.
It's sorry to interrupt you, Nick. It's one of the things that we found most challenging when we were implementing things through Excel, and then we were trying to migrate into the finance system, was finance systems are very good at obviously setting the targets, setting the budgets, all of that, and then you can do all your model metrics every month, blah, 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 all of that stuff for budget holders. But having that module in there that gives you a ESG evaluation of a division, i.e., okay, here are your environmental metrics, whether it's carbon emissions or energy usage or water usage, et cetera, et cetera, et cetera. Here are your social metrics, and I know that next stage. We're at MH, we've done a lot of work around societal frameworking in terms of, because that is very important to investors now, and you need to look at the scandals that you see. And then obviously governance, which is probably less related to budget holders, but again, from a top level perspective in management accounting, how are our governance metrics performing? And finance functions or finance software isn't there yet. And I think that's a really big thing that CFOs would welcome. I certainly would, because at the moment we do it all manually. So is that something that's going to come through on Aptitude or platform so forth?
Absolutely. I mean, I think for any software company, the challenge at the moment is, given the regulations are evolving, it is around agility. So for us, it is having, almost generic calculation capabilities that will allow you to, allow our customers and clients to be able to set up their own calculations, because as requirements evolve, we're going to have to obviously evolve the products alongside it. We're also seeing a trend where obviously there's a lower, a lot of this, and this is a change in skill set, I guess, within the finance organization as well, is how do we really pass the responsibility for defining the calculations to a finance function to implement, so that actually we can operate in almost a low code or no code environment where, it's quite simple for a finance user to configure a calculation, see the outputs, and then obviously change the calculations as required, because obviously it's a new area, and part of this will be, I don't want to say trial and error, but it will be an element of understanding what data is available, what calculations can we perform, how will those metrics actually suffice the business needs, and then obviously it's an evolution of those metrics as regulations evolve as well.
I think FDs really need that support, because at the moment, and I know because I've got colleagues in numerous sectors, obviously agriculture, food and farming, and financial services is where I spend a lot of my time. I know that's kind of like a bit of an oxymoron set of sectors that I deal with, but nonetheless, they're doing it themselves at the moment. Obviously, the bigger entities have got departments, obviously the listed companies, but those mid-cap companies kind of go, oh, someone's going to have to pick this up. Oh, I guess it's the CFO. And software is not ready yet. So I think it's a really big kind of call to action or shout out, because when the auditors come in, I put my audit hat on, what we look at climate risk as far as going concern is, and if you are an agricultural producer and you're producing, let's say, apples, and you are completely reliant on that crop to manage your going concern and your cash flow, what steps have you put in place in finance in terms of your forward scenario planning to take into account transitional risk and physical risk around climate risk? It's broken into two. So that for me it's again that scenario planning and how things can evolve in the future, because at the moment FDs need that support. And that's very different to kind of implementing your ESG processes in the business to make your business more effective. This is about dealing with that other, because regulatory is one side, reporting. It's also about having your account side.
And I think, Nick Shah, it'd be quite good just to explain a little bit how we at Aptitude are thinking about that in terms of the trajectory of the finance architecture, because we believe that the general ledger is now no longer going to be the place to capture all this information. There needs to be a much richer data set that is still within the control of finance, whether we call it a subledger or something else. But it'd be good just to explain a little bit what we therefore see from a technology and an architecture perspective in terms of how everybody should be thinking about evolving their finance architecture and how technology plays into that.
Yeah, absolutely. I mean, the story of the general ledger has been well told, but I think as we've seen with the growth of data, the expansion of the needs of finance from not just from a regulatory reporting perspective, but also what's required to manage the business and drive the right business insights and decisioning, there's a limit to how far you can take your general ledger in terms of the granularity and the additional dimensionality you need with that data set. So what we're starting to see is that trend for firms to implement a granular ledger solution, effectively a sub-ledger solution that provides you with the same accounting and the control flows that you have over your general ledger data set, but lets you bring in non-financial data sets that you can integrate with your financial data sets as well. And it's a really powerful solution. I think with the evolution of technology, it's become a lot easier to do with cloud native solutions, because the concern of obviously in the past had been very much around performance, but new technologies obviously help to remove that as a barrier. Secondly, that ability to integrate new data sources and integration of financial data with non-financial data is becoming far more critical. I think Mark's made a really valid point as well. It's around forward looking as well. It's not just around being able to report on what's happened in the last period. It is saying, what do we think is going to happen in the next quarter, the next year, the next 3 years, to have that forward looking element where future risks and scenario planning can be factored in. And that's where the subledger is absolutely key, because having that single rich granular data set in finance firstly gives, particularly at larger organizations, gives everyone in finance a single starting point in terms of the underlying data, so that we don't have different parts of the finance function looking at different data sets or having different reconciliation challenges. So, really being able to drive everything off that one singular accounted controlled data set is absolutely key in the architectures that we're implementing.
And there is, of course, as we've said many times now, there is new data sources that finance functions in particular are going to have to be able to acquire, integrate, and then report on. Nick Stewart, I'm just interested on your perspective. Of course, Baringa has an industry-leading climate change scenario model that's being used, by BlackRock amongst others. And I'm just interested, thinking back to the Basel and IFRS kind of world. A lot of those new data sources had to be created in-house. How do you see this topic actually potentially changing that and organizations being able to acquire data sources and solutions more widely to be able to actually help them with that rather than having to rebuild it from scratch themselves?
Yeah, I mean, I think I've been immersed in this probably for the last 4.5 years. And again, I think to your point, many of the data providers, and if you look at places like Bloomberg, Fitch, S&P, a lot of I often hear clients, particularly in financial services, talking about how, like we saw for credit ratings, we'll see the same thing for climate and wider ESG ratings. So I think there will be there'll be a move towards open source, i.e. anyone can access the same data set in time. But at the moment, we all know if you're a company, often data arbitrage or having better data gives you an advantage. So we're seeing some of the companies that are leading in this space have invested in new data sets. And like you said, Christoph, whether that's them looking at their own supply chain and understanding it better, whether that's procuring data from third parties, like some of the ones I mentioned, or using model solutions like we developed at Baringa and now are in partnership with BlackRock, and they're going to use it to provide that to many clients. So I don't think we're going to see the open source. You can look at everything up on Bloomberg next year. I think it's going to take a good few years for that to happen. But I think, as all of our panelists have said, the ability to understand the data needs in the organization and where you're going to procure it, and importantly, as Nick said, how you're going to control, report, manage, govern, audit it, is going to be a key thing. Again, it's going to help companies manage risk, but also, I often use the phrase, is monetize the opportunity. This is also about making money as well, making money in the right way, I should say. I'm not, one of those that advocates any form of greenwashing or anything, but doing the right thing by your customers, by your products. And there is clear advantages to doing that. And you can see that through traded market examples of where leaders are excelling.
Great, thanks for that, Nick. So before we do our final question, I just wanted to put up our second poll. And having listened to all of this, we'd just be interested to hear from you where you see the key impacts of ESG regulation on your organization. And that would be really interesting just to kind of hear from you, and we'll kind of get those results back to you shortly. So my final question is maybe just a little bit more sort of what you're hearing and seeing with your clients, in as much as you can share it. We had a view earlier in the poll as to where people are at, but it'd be maybe interesting to hear a few more stories of where people are doing it right now, where you think organizations, finance functions in particular, are on track to being well prepared in their response to ESG, and maybe some strategies that you are seeing to be more successful than others. Because again, I refer back to my long experience of IFRS, Basel implementation, and so on. It took a very long time for there to be a good strategy to emerge as to how you respond to those ever emerging new exposure drafts and standards and so forth. So if I can start with you, Mark, maybe just, what are your war stories? What are the good ones and the not so good ones that you're kind of beginning to see out there?
It's been a journey, I would say. I was dealing with sustainability. So I'm going to give you kind of my personal experience, and then I'll talk about some of the clients we deal with. So back in 2008, in the group, the Hadler group that we built, we decided that actually corporate and social responsibility and environmental agendas needed to be addressed. So we developed a sustainability curriculum. We developed, which is kind of like the end of the world is coming. We're actually, the lecturers are quite far ahead than people today, actually, 2007. So we created a framework which was using less for a more sustainable future. And in the organization, about 1,400 people, they thought, what are you doing? Why do we need to worry about any of this? And it was an absolute culture shift. But we did it partly because I happened to be the CFO and deputy deputy principal CEO, meant I could implement it because I said, we're doing this. The board was behind it and we drafted a strategy, but we also made the commitment to put money into it. And I think this is an important point that I'm going to make. Probably Nick may well come up with those. ESG is not going to be free. You have got to make the commitment to put some money into it if you're going to do it properly. And I'm very, very direct about that. So we did that, made a difference, numerous awards, blah, blah, blah. And we, in those days, we were recording our carbon emissions, we were managing our energy usage, etc. And we had a very, very good strategy, and it was a whole college group approach. Roll the clock forward to today. Obviously, it's now in the zeitgeist. People are talking about it. There are two types of clients, bluntly. One, there are those that have embraced this and have been embracing it for a number of years. And you see some real success stories in the food industry, really big success stories where they've completely overhauled their entire business model and putting sustainability at its heart, looking at every single product chain, every single process, but it is invariably led by the finance function. And in most of the businesses that I've been in, the CFO, C-suite lead for money, whatever you want to call it, is invariably got the remit of sustainability. And that might have a direct report to board at the same time, but they sit within that remit of the finance lead because everything costs money, right? Or saves money. So I find it most successful there. Where I found it least successful, and obviously that associated report, where I found it least successful is where they say, okay, right, somebody needs to take on sustainability. Well, they'll either create a role because they think that's the right thing they should do because I've seen other people do it at a particular level, maybe director level, maybe underneath that, reporting to someone who doesn't really particularly want it. And they're left to get on with it as an individual in a fairly large organization. And it doesn't work because it's not led from a global board structure or at least a strategic plan. And the CFO isn't involved. If the CFO, he or she is not involved into that process, it will not work. So, and I've seen that in mid-cap businesses. And kind of like the one particular war story that I will share is we went into a business, we presented what they needed to do. They quite a large business. There was one individual responsible for it, presented a big strategic plan to look, you need to work with a partner, whether it's us or somebody else, you need to work with that partner. They said, no, we'll just get on with it ourselves. So they used what we'd suggested, did it themselves, and then 6 months later came back and said, we've made a complete mess of this. We desperately need your help. And it's not a punt for services, trust me. Organizations like Nick and ours, we're incredibly busy because we also are very frank about it. We'll tell you what you need to do. We won't greenwash it. We won't say, oh, it's okay. You can just do a bit of reporting and everything will be all right. The TCFD agenda is square and center and it's coming down the track. And if you don't think it applies to you, you're probably going to be wrong. So that business came back and they listened second time around, and we did it through a series of processes. And I know we haven't talked about S much today because obviously we're talking about the wider ESG agenda, but the S and the G, which we say is as important as the E. And the other shout out I would say is when we do our implementation processes, we talk about creation first. Let's create a framework based on what you already have, because invariably you'll probably be doing some stuff, you just don't know it yet. And then you evaluate, then you implement. And that's very much the MHA way. And at the other end of that, there are opportunities, and there are opportunities out there with green finance and green investment and green innovation that will start to get you that return on investment from that initial money you put in. But if you think you can just do it on the cheap, then think again. Sorry. So yes, I didn't mention any client names because it would be inappropriate. However, they're those that don't listen ultimately listen in the end.
I was going to just add to Mark. I completely agree. One of the points you said there around, I mean, ultimately, why do this? The CFO, the finance department, what is your core job? Is to manage the financials of the organization. So, yes. I mean, I'm just writing down, if you think about ESG more broadly, whether it's the cost of your debt, which is going to go up, frankly, if you're someone that needs money to run your business and you're not ESG compliant, it's going to cost you more. If you're in a regulated market, we often talk about managing revenue, capital. Carbon is going to be the next constraint. We're going to see the regulators in time put a price on carbon. If you're a company that has a good brand, I mean, Mark mentioned it, Baringa, we're the same. We see a return from being a very thoughtful, we're now a B Corp, focusing not just on people and profit, but also the planet. We see a value to that. It's hard sometimes to put your pounds and pence on it, which us accountants love to do. And the last thing is employees. Nick Shah mentioned upskilling. What better an opportunity do you as a finance person have to learn a new skill, to do something that's good for the planet, the environment, and also it's good for your organization? And I know I saw in the chat, there's other non-profit organizations as well, but whether the value, you need to return that value to raise more funds or to get more charitable investments. And the last thing I'd say, which is why for me it's very a personal passion, is my 3 daughters who are 5, 11 and 14, it's the only thing they've ever been interested in that daddy does at work and has done for the last 25 years. So if that's not a motivation for you to get involved, whether it's your friends, family, whoever, then I don't know what is.
I'd actually just add that final point. You know, when you mentioned people, it's, and I feel very strongly about this, which is why I lead the S, is my personal journey has been an incredible journey. And I'm now back at the firm I trained with at the very beginning. So I've kind of come full circle. Arguably, I just had a 15-year secondment, as we say internally. But my point is the societal license to trade, which is what we talk about here, is going to be fundamental, because whilst money is a fundamental driver in life in terms of the ability to afford and the ability to pay for things, that societal balance of doing the right thing with your money is going to become more and more and more of an important point. Irrespective of what I think Unilever announced the other day, saying that profitability needs to be more important than this, than environmental sustainability. I think the chief executive was in the news the other day. I think irrespective of that, the mood music isn't going to change. This isn't like Y2K, where everybody suddenly thought we need to sort our computers out. And then on the 1st of January 2000, it was all okay and that industry disappeared. This is here to stay. Because if we don't, we will not be able to live properly because it'll all be flooded. So let's not get back to let's get back to that point about what the IPCC said. So just a really important point about the societal licensing, if you want to be an ethical company. Sorry, Jeff. Final point from me on that. That was all.
That's great. So let's go briefly. We have had some fantastic questions, and there's been a little bit of interaction as well on the chat. I'm not 100% sure whether everybody can also see the answers. So we have one question. I know, Nick, you've answered it, but maybe just for the benefit of the audience as well. It's from Faith, who's saying she's working with an NGO in Nigeria, and we've talked a lot about for-profit making companies, but just a bit of a perspective around what does this all mean for not-for-profit making organizations?
Yeah, I mean, I think, as I said, I mean, Faith, firstly, well done. And it sounds like you're on a very important role. We do a lot of work at Baringa with the charity sector, particularly in the UK, and not, non-NGO or non-profit. And my points would apply the same. We all have whatever organization we're in requirements to meet, whether they're for you raising money, getting support, getting donations. And I do think that having a sustainable strategy, which means, and I make the distinction between a sustainable strategy, i.e. a business strategy that is sustainable, as opposed to Mark made this earlier, a sustainability strategy that sits on the side and has no teeth and no cadence, I think is equally as important whether you're working for an NGO or a non-profit, as you are for a company that is a profit-making company. So that would be my reflections.
So another question, which actually also I've kind of been wondering over the last few months, is from Bogdan, who's saying, look, we're talking about finance as a host for ESG, but what about the role of finance if ESG has separate departments in the organizational design? And where I think we're seeing a lot of an emergence of chief sustainability officers, they might even be sitting on the board who are not the CFOs. And just curious to kind of get some thoughts both from Mark and Nick Stewart as to what are actually the different models and how could they sort of interact with each other?
I mean, all I would say was with the frameworks, and it comes back to what I said about creation at the very beginning, you can make the interaction work by having a framework that isn't just all about climate risk. In other words, it's not just all about your emissions, your CO2, and the energy that you consume. It is about looking at your business as a whole. So my point about societal licensing to trade, and whether that's looking at, and I know the charity point was a very good one. S is massively important for charity, whether it's looking at economic disparity, ED&I, and participation in that, or simply digital rights and protection of data. You incorporate all of that into your ES and governance framework, which means as the CFO, you call on those other divisions and departments that affect that. So I'll give you a real life example. Before this call this morning, I had a session with our partner in charge of global HR for MHA, lead member of Baker Tilly International for UK. And we were talking about how HR will integrate into MHA's overarching social frameworks, and said, we can't do this without HR's input, but it also gives HR further teeth to go and do the things that perhaps they couldn't have done otherwise because they've got a mandate. So flip it on its head. ESG is actually quite a positive thing for certain departments to go, well, hang on a minute, we couldn't do this 2 years ago because you said it wasn't relevant, but under ESG it is, so can we please now do this? So you use it as a tool for change, and we're seeing that more and more and more. It's how you frame that, and also having the confidence to frame it in that way. One of the things I would just say finally on this point, shout out, is for too often businesses are blagging it and they're thinking they understand ESG, but they're not talking to the experts that truly know. And please do, not necessarily us or Nick, talk to people who really do walk the walk, because there is a whole industry out there that isn't necessarily saying the right thing, and it is a complex sector.
And Nick Stewart, how are you advising your organizations in terms of just the org design and the distribution of accountabilities?
Yeah, I mean, Mark touched on it, but I think the big thing for me is about collaboration. We've talked a lot about collaboration at the top. I see one of the other questions. I can try and help you, Christoph, answer it. There may be a CSO who is the designated person on the board that owns sustainability. But I think, as we've said, the CFO, the CEO, the other execs that have real ownership have to drive and bring this together. And if we go back to where we started, if you look at things like TCFD, the same thing happened with IFRS 9, the same thing happened with other major changes. Ultimately, the finance function and probably the CFO is going to be the person that has to sign off the accounts, stand in front of investors, stand in front of employees alongside the CEO to say what they're doing, how they're reporting it. So the sooner you get ahead of that and think about the operating model, as you said, Christoph, the better. And not to scare people, but I find the op model work that we do in strategy this is all encompassing. This starts with, right from where you make products and how you engage with customers through the entire ecosystem of the organization. So again, the sooner you start engaging on it and bringing the relevant functions together, and any person, doesn't matter where they sit, but if the CFO being a central leader driving that, then what better a way to get advanced on this journey, which is a big journey that's ahead of us all.
Great, thank you, Nick. And maybe just Nick Shah, just on this topic as well. Finance technology teams often sit either reporting to CFOs, sometimes they sit in the CIO function, and sometimes they kind of sit in the middle. But we've talked a lot about how none of this is going to work unless the technology direction and the execution kind of works as well. What's your advice to finance technology leadership in terms of how they need to fit into this, which could still be a disparate set of accountabilities, and maybe just reflecting on the experiences you've had between CROs, CFOs, treasurers, etc.?
Yeah, absolutely. I think it is. I mean, it will vary by organization, just given complexity of organization and the state of the finance or broader risk architecture. I think what we're seeing from clients that we talk to, we're seeing organizations which may well be using the ESG regulations as a need to therefore transform their finance and risk technology architecture. So, we often start compliance programs with the intention of, redesigning, transforming the way the organization operates, but often end up with, back to a minimum compliance standard. I think we are seeing organizations using ESG now to say, well, actually, it's another driver on top of some of the regulatory requirements we've had over the past 5 to 10 years. To look at the overall data architecture across the enterprise, whether that's looking at it from a data warehouse, enterprise data lake perspective, and seeing how we integrate finance solutions into that. I think what remains key, though, from a finance perspective, is the controls elements and that transparency, the auditability of the data that we bring through. So I think that when you're looking at this from a technology perspective, you absolutely need to look at your existing assets, what you've got in place that helps meet those requirements. But then really assess where do we need to invest in new technologies. As Mark made a really valid point, this isn't going to come for free. There will be new capabilities, new solutions required. Understanding how that impacts on people, technology, processes, governance is going to be key in terms of from a technology leadership perspective.
Fantastic. I'm going to draw this to a close. Thank you very much, Nick and Mark. It's been a really interesting conversation. Maybe my main takeaways as a summary for all of the participants is, number one, I think get engaged in the journey, get engaged, be at the table to influence the direction. The second is focus on the planning, make sure you have an execution plan in terms of how you're going to go and deliver this. This is a long-term journey. I think, as Mark said, it's not just going to go away overnight, it's going to be there forever. And maybe just to paraphrase Nick's daughters, this is for the future. And, everybody, I think, is looking to everybody on this call to make this work and to make this happen. So thank you very much. Thank you very much, all participants. And as we said, this will be available online very shortly.
Thank you very much.
Thank you.